Okay, folks, I'm going to get started. Reminder again, I told you on Monday, but I want to tell you again, next Wednesday we will have just Zoom, so not in the physical class. Next Monday, of course, there's no class, so next Wednesday. Okay. I also sent a little, I know a few of you are feeling a little overwhelmed, so I sent a little guide on what you should do with your limited time, because I understand you have other things competing for your time. And especially as you go through into week 4, 5, midterms start to come up, you're saying, you can't spend this much time. So I will send you kind of a variant of that again today in my email on if you're really busy, here are the 4 things you should do each week. If you have more time, here are the 6 things. Now, obviously, I'd like you to do everything every week, but I'm a pragmatist, so I will push you to do as much as you can. So hopefully you will get your company nailed down, because the other thing I'm going to send out is a packet on getting data. Now, we assume it's easy, and it is easy, but you still, if you've never used Capital IQ or a Bloomberg terminal before, if you look. Sorry. So you can see. If you've never used Capital IQ or a Bloomberg or the SEC site or pulled up a 10K, it can be daunting. So I will send you a little guide on how to get there, and because data is the building block for everything you do in the class. So you need to get the data, and of course, to get the data, you need to pick a company. So that gives me a chance to nag you again, pick a company. So today I want to complete our discussion of risk and return models, and then get into the process of estimating the numbers you need to come up with a hurdle rate. Remember when I left you last session, I talked about how diversification is good, but we still all stop diversifying at a point in time. And I gave you 2 reasons. One is we think we can pick the best stocks. And the second is we, for whatever reason, have transactions costs, monitoring costs, information collecting costs. Those costs become larger than the marginal benefits, which get smaller as you add stocks. So we stop at some point. For some people, it might be at 9 stocks. For some people, it might be at 45. For some people, it might be 2,000 stocks. But we all find a stopping point. And then I told you in the CAPM, we make 2 big assumptions. One is no transactions costs. And the second is you can't pick stocks, no private information. If you cannot pick stocks and there are no transactions costs, the limiting case for diversification is you'll never stop diversifying. So let's say this is the entire market. We live in the CAPM world, and we're all fully diversified, holding this market portfolio that includes every single traded asset in the market. That sounds outlandish, but if you think about it, we're not that far away from being able to do that, right? Get on the Vanguard website. Vanguard is the largest index fund operator in the world. You can buy the S&P 500 index fund. That's been around since the 70s, but now you can buy a global index fund. You can buy an index fund that includes both stocks. This is not that far away. So that market portfolio, which was, when it was developed in the 60s, seemed like this pie in the sky, is now here. So we're all in this world. We all want to own that market portfolio. And we all have that direct line, an online or an 800 number you can call and decide how much of your money to put in that market portfolio. Here's the puzzle though. If we all hold that same index fund, the question you're asking is, how will differences in risk aversion across people show up? Let's face it, some of us are willing to take more risk than others. For whatever reason, you're younger, you're wealthier, you have other things that you have a good income stream, you don't think you lose your job, whatever it is can feed into risk aversion. So we're going to play a game. We're going to take 4 people in this class. So you are going to want to take no risk at all. You want to take some risk. You want to take more risk. And you want to take the most risk. So in terms of risk aversion. So if you want to take no risk at all, and I come to you and say, how much money are you going to put in this market portfolio? What's your answer going to be? You're just going to buy risk-free investments, right? Why would you want? So he's going to be 100%. So basically you have 2 choices, and this is where the second choice comes in. You can buy the index fund, or you can invest in something risk-free. Let's say it's treasury, so you put on 100%. You want to take some risk, so you might say half my money goes into treasuries, half goes into the index fund. You want to take even more risk, you put all of your money in the index fund. But Nitin now has a problem. He wants to take even more risk. So what are you going to do? Why can't you buy? The question is, and this is a legitimate question, why don't I just buy the riskiest stocks in the market? Because it's not an efficient way to take risk in this world. The most efficient way to take risk in this world is to stay with that diversified portfolio. But here's how you increase your risk exposure. You borrow money and you buy that index fund. What does it do? It magnifies all risk. Borrowing acts like a magnifying glass. In this world, every single investor will only hold one or two things or a combination. A risk-free investment, this index fund that has every single traded asset in the world, and all that will set us apart is how much of each we own. And it changes the way we think about risk. So now when I come to you with a particular company and I say, how much risk should I take? Here's how you measure risk. Remember, you measure risk in an investment based on the risk it adds to what you own. And what do we all own? We own the market portfolio. The risk we then look at is the risk that it adds to the market portfolio. So I ask you, how risky is Disney? Well, you look at the risk Disney adds to the market portfolio. How risky is NVIDIA? Risk that NVIDIA adds to the market portfolio. It's a huge difference from the way we used to think about risk, because risk now becomes risk added to that market portfolio. I mean, I know you went through a statistical derivation of beta, but beta measures the covariance of your stock with the market, or put simply, how your stock moves with the market. Or in intuitive terms, it measures the risk added to the market portfolio. That's what beta is. You'd be amazed at how much misunderstanding. You ask people, what is beta? They say beta is volatility. No, it's not. Beta standard deviation. No, it's not. It's a portion of the standard deviation that can be explained by the market. Can you be a risky stock with a low beta? Absolutely. Can you be a safe stock with a high beta? That too can happen, and we'll talk about that variation. But basically, beta measures the risk added to a market portfolio, but think of how much baggage we've accumulated to get to that point. We had to assume we lived in a mean variance world. We talked about how dangerous that was. We have to assume no transactions cost, no private information. You're saying, this is so unrealistic. Guilty as charged. But here's what you get as a price. At the end, you get one single number that captures beta. It's a standalone risk measure because beta standards are around 1. And here's the final bonus. If you can tell me what the beta of an investment is, I can tell you what the expected return on that investment will be by starting with the risk-free rate. That's going to be my base. And multiplying the beta by this difference that you expect to earn on the market portfolio over and above the risk-free rate. We're going to call that the equity risk premium, but it's the price of risk in the equity market. Risk-free rate, beta, equity risk premium. You can see why the CAPM very quickly caught on. 1964, it gets derived. By the late 60s, people are using it because it's a very simple model. It needs only 3 inputs. Only one of those relates to your company. The risk-free rate and equity risk premium have nothing to do with your company. But across, as we've gone through time, there have been pushbacks. And there should be pushback. When you have a model takeover and people are using it, you have to start asking questions about, hey, are we using the right model? Let's take the 3 big critiques of the CAPM and deal with each of them. The first is that it makes unrealistic assumptions. Does it? Absolutely. In fact, we laid it out, right? Mean variance world, none of us lives in it. No transactions costs. Remember, there's a bid-ask spread even if the cost of trading goes towards 0. And no private information. We know there is inside information. There's leakages of information. You know what? That critique has never bothered me because in a previous life, I started as an econ undergraduate. And I still remember these economic models that made realistic assumptions that nobody could use. I'll give you an example. Models built around observing the utility function of individuals. You can build these amazing models. And then you ask your econ professor, how would I ever observe the utility function of an individual? The answer is you cannot. But once you observe it, it's all going to get clear. Given a choice between making realistic assumptions and ending up with models that nobody can use, and making unrealistic assumptions and ending up with models that I can use, I'll take the latter over the former every single time. The second critique will usually come from that guy in the back row. So when you talk about, so maybe you're using the beta to come up with the cost of equity for a company. He'll put up his hand or she'll put up her hand and say, but you could be wrong. About what? Your beta could be wrong, your equity risk premium could be wrong, maybe even your risk-free rate is wrong, to which my response is, that's all you think I've got wrong? You should see my cash flows, my growth rates, my margins. They're all wrong. Why are they wrong? Because I'm trying to forecast the future. If your measure of a model is if I'm wrong, I will not use it, you're going to be paralyzed. There is no perfect model out there. Every model is going to be wrong. So the first two critiques, you can throw to any economic model, and they're not going to stick. The third critique, though, cuts to the bone. What do we say a good model should do? It should be able to explain what's going on, right? So if you believe that the CAPM is the right model for risk and return, the only variable that explains differences in returns across companies, remember the risk-free rate and equity risk premium are the same for every company, is the beta. So if the CAPM is right, and I look at a very long period, not 1 year, not 5 years, let's say 40 years of returns or 30 years of returns on stocks, and I look at the differences in returns across stocks, what percentage of those returns should be explained by betas if the CAPM is the right model for risk? 100%. And in 1992, two professors at the University of Chicago, Ken French and Gene Fama, decided to test this proposition out. They said, okay, let's look at what percentage of actual differences in returns are explained by betas. Remember, you want to see 100%. I think they found 11% or 9%. Or that's a charitable way of putting it. Put more starkly, we're using a model that doesn't explain about 90% of what's going on. Slam dunk, right? And this has been the reason people say, why are you using the CAPM? Look, it's wrong 90% of the time. True. But let's look at what the alternatives are to the CAPM, and maybe you can see there why the CAPM survives as the model in use. For 14 years, the CAPM was the only game in town. It was CAPM or nothing, and the CAPM won every single time. In 1978, Professor at Yale, Steve Ross, said, hey, look, the CAPM is trying to measure the risk you cannot diversify away. It comes from macroeconomic risk forces. Why? Because if you cannot diversify, it must affect most companies. He said, why are we using one beta to capture all of these different macroeconomic risks? It could be interest rates, inflation. You could have multiple macroeconomic risk factors. Why don't we allow for multiple factors and multiple betas? Sounds like a good idea, right? And when he came out of this, the pushback was, how would we know how many macroeconomic factors there are and what the betas are? And he said, that's easy. Give me about 30 years of stock price data, and I can back out from the data how many macroeconomic factors there are and what the betas are. He's saying, how would you do that? The answer is actually very simple. What's the essence of market risk? It affects many or most firms at the same time, right? So he takes the data, 30 years of data, and you look for patterns. It's called factor analysis. It's a statistical technique for going through data, looking for common factors that seem to cause price. So after several million, in those days you had to do a mainframe, all this data, several $1 million, model comes back and says, there are 5 factors that drive stock returns. And thus was born the arbitrage pricing model. And when it first came out, people said, this is amazing. We've replaced this one beta that tries to capture everything with 5 betas and 5 factors. Because one of the outputs from factor analysis, not only do you get the number of factors, it gives you a beta for every company against each of the factors. So let's put yourselves in the shoes of a banker in 1979. You've latched on to this arbitrage pricing model. You decide to sell this to your client. So you're the banker. Let's say you work at Salomon Brothers. I'm Pepsi, your client. And you show up in my office and say, I know you've been using the CAPM to get your cost of equity, but you have a better model. It's called the arbitrage pricing model. And with it, your cost of equity is 16%. And you're shocked. Why? Because with the CAPM, it was 12, and now I'm saying it's 16. She asked me, why is it so high? And I tell you, I said, it's because you're really sensitive to the second factor. What's your follow-up question going to be? What the heck is the second factor, right? And to which my response is, I don't know what it is, but be very careful when it's around. A factor analysis is a purely statistical technique. The output from the factor analysis, there are 5 factors. You know what the model calls them? Factor 1, factor 2, factor 3, factor 4, factor 5. There is zero chance that any company is going to jump on and use this cost of equity until you can name the factors. So for Lon, you go back to your office and you think of how you can get around the problem. How do you get around the problem? If you could just attach names to the factors, you'd be home free, right? Now you know they're macroeconomic variables. And one of the things you get from a factor analysis, you get graphs of each factor over time. So think low tech. If you want to figure out what factor 1 is, you're going to check out what inflation look like, interest rates look like, and you try to, there are statistical techniques you can use to do the matching. And 4 or 5 years later, you started to see people come up with names for the factors. The first factor is the level of interest rate. The second factor is the slope of the yield curve. The third factor is default spreads for bonds. You now have names for factors. When you attach names to factors in a multi-factor, you go from an arbitrage pricing model to what's called generically a multi-factor model. Still, you're staying with the same theme. The only risk you care about is the risk you cannot diversify away. You're now capturing them with 5 factors and 5 betas. Mission accomplished, right? By the mid-80s, we had factor analysis, factor models that actually did much better than the CAPM in terms of explaining past returns. But they never caught on. The reason they didn't catch on is factor models are very good at fitting factors to past returns. I'll give you an example. In 1985, you have a 5-factor model. You show up at Pepsi. You now have names for the factors. You tell Pepsi your cost of equity is 15%. And they say, that sounds high. Why is it so high? And you say, it's because you're very sensitive to the second factor. Now, you're ready for the question. In fact, if they don't ask you, you would ask yourself, what's the second factor? And you say, it's oil prices. And you say, what? We don't use any oil in Pepsi. That might taste like we do, but we don't. Excuse me. Do you see what happened? Oil prices were a big factor driving stock prices in the 1970s. You fit a model that brought that in, but by the mid-80s, oil prices were no longer a factor driving stock prices. It's great at explaining past returns, but it's not very good at forecasting expected returns. The model, the factors keep shifting, the betas keep shifting. So with each new model, people said, this is the model to replace the CAPM. I described the CAPM as having died more often than Freddy Krueger. It dies and it comes back because a new model comes in. People said, this is great. And then they said, this doesn't work that well. And finally, in 1992, as part of that study that French and Pharma did on explaining past returns, they said beta doesn't work. But then stop this. Let's try what else explains differences in returns across companies. Purely statistical exercise. You have 30 years, you have thousands of companies, you have the returns in every company. Betas don't seem to explain the difference in returns. They said, what else might explain the differences in returns? And they found 2 things that explain the difference in returns. And the data they used was between 1963 and 92. One was the market capitalization of the company. They found that small companies earn much higher returns than large companies. The second factor they found was the price to book ratio, the market cap as a percentage of the book value of equity. They found that low price to book ratio companies earned higher returns. And then they made a leap of faith. Gene Pharma, after all, found one of the starting people to think about efficient markets, won a Nobel Prize for it. He said, look, if markets are giving higher returns to some stocks, they must be riskier. You see why this is a leap of faith. If markets are right, that's the only way you earn a higher return. And then they made the final leap. If that's true, then small companies must be riskier than larger companies. That's why they earn higher returns. Low price to book stocks are riskier.
There's no intuitive or economic rationale. You're letting the data tell you what risk is. We call these proxy models. You're letting something stand in for risk. And in the years since, there are other things that people have discovered, because as we get richer and richer data, they start to add more things that explain past returns. Again, if you think purely in terms of R squared and explaining the past, these proxy models will beat the CAPM hands down. Why? Because you're searching through the data for something that gives you a higher R squared, right? Statistically, it's almost impossible for a proxy model to underperform the CAPM because you're searching for variables that give you the highest R squared. There's an element of data mining here, right? You're basically...
Excuse me, Professor.
The element of data mining here is you're essentially looking at the data, looking for variables. No, you might have thrown in a Super Bowl indicator. Do you know there is a Super Bowl indicator that people have talked about every time a Super Bowl comes up, that if the AFC team wins, it's good for the market. The NFC team wins, it's bad for the market. 40 years of data, statistically you can show it, but it's completely meaningless. You have spurious variables. So when you think about these alternatives and why they haven't really caught on, there's a reason. Because ultimately, I'm sorry, I have to get back into my slides, otherwise I can't slip. You have to have a model to beat a model. And the CAPM persists because while these other models are better at explaining the past, they're not much better at giving you expected returns. So when you have to defend the CAPM, don't go overboard. It's a great model. It does amazingly well. Remember the words I used to justify it? It does at least as well as the next best model. And guess what? It's much simpler to compute. So why would I compute 5 betas and get the same kind of crappy expected return as I can get with 1 beta and 1 expected return? I do think that much of the problem with the CAPM, don't worry, the slide is there. You just can't see it now. Much of the problem with the CAPM comes from the way we estimate betas. And I'm going to talk about better ways of estimating betas. But I'll tell you, even if you get everything nailed down, I don't think you'll ever be able to explain more than 25% or 30% of the difference in returns across stocks. You know why? Because there are 66 million people walking around thinking Elvis is still alive. There's a lot of noise in markets, a lot of irrationality, a lot of craziness. It's hubris to think you can build a model that explains 95% of what's going on. You will always undershoot. But the people who want to abandon the CAPM happen to be managers and portfolio managers and managed companies. And you know what they want to replace it with? Gut feeling. You think the R squared between the CAPM and returns is low? You should see the R squared between gut feeling and returns. They want to say, I want to use whatever hurdle rate I want. Why are you getting in my way with this stupid model? And my reaction is, because I don't trust your gut. So when you look at models that are essentially... No, you can accept the fact that they're going to be imperfect, but you're doing the best you can with what you have. I do think as our data gets richer and we can estimate these models, maybe a new model will come up. And here's where I'm going to make my stand. I am not some true believer in the CAPM. I'm not going to, this is not the hill I want to die on. I'm a pragmatist. I need a hurdle rate. If you can give me a better way of doing it, I'll take it in a minute and run with it. But remember, all of these models are built on what premise? That the marginal investor is diversified. And that's where I want to start you to start your risk analysis. Take your company, look at who owns stock in your company, individuals or institutions. Take a look at that top 17, 19 investors in your company. Make your judgment on whether it's okay to assume that investors are diversified. That to me is a much, much bigger assumption than everything else you do in terms of picking models. And for some of you, you might end up with this unpleasant conclusion that in your company, the assumption that the investor is diversified is not good. For the moment, that'll leave you unsatisfied, but we'll close the loop and talk about what to do when that is the case. So enough with kind of big picture stuff. Let's get down to mechanics. If you think about it, to use the CAPM, I need 3 numbers. And everything I say about the CAPM, you can extend to multi-factor models. So if you want to do multi-factor models, when I say beta, think betas. When I say equity risk premium, think premiums, because all that will happen is you multiply it. You need a risk-free rate, you need a beta or betas, and you need equity risk premiums. Just without even looking at the numbers. Which of these should be the most straightforward of the three numbers to get, you think? Risk-free rate, right? I remember when I did my MBA, I think we spent 30 seconds of my 2-year MBA program talking about risk-free rates. I was told to use the US Treasury rate. And then we moved on. Shows you how dollar-centric MBA programs were and how much trust there was that if you had a US Treasury rate, you had a risk-free rate. So let's step back and think about what it is you need for an investment to be risk-free. For an investment to be risk-free, it has to meet two conditions. The first is the entity issuing that security cannot have any default risk, not even an iota. There can be no default risk. That's a pretty straightforward assumption. The second is there can be no reinvestment risk. Now that might sound mysterious, but remember last session we talked about how if you have a 1-year time horizon, a 10-year T-bond is not risk-free because at the end of the year the price could change. And if you have a 10-year time horizon, a 1-year T-bill is not risk-free because then you have reinvestment risk. I mean, this is where it'll lead us. If you ask me what the risk-free rate is, I can't answer you until you tell me over what period. You say, I want a 3-year risk-free rate. I'm going to give you a different answer than if you have a 7-year risk-free rate. So let's say you wanted a 10-year risk-free rate just for your 10th year's cash flows. Given what I just said, and assuming the US Treasury is default-free for the moment, how would you get a risk-free rate for your 10th year's cash flow? What would you use? The 10-year bond seems like an obvious answer. There's one small catch with the 10-year bond, which is you get coupons every 6 months, which you have to reinvest at rates you don't know. So is there a way to clean up for that? You can take the coupons out of the bond. In fact, it's called a zero coupon bond. People have done this for 20 years or 30 years. You can take a 10-year bond, take the coupons and strip them out and sell just the 10th year's cash flow. You go onto Bloomberg or you go onto many public sites, you can actually get the rate on a 10-year zero, a 9-year zero, an 8-year zero. If you're a purist, and I'll admit up front I'm not, and you wanted to get a risk-free rate, here's what you should be doing. You should have a different risk-free rate for each cash flow. So let's say you're doing a valuation, cash flows in year 1, 2, 3. Each year's cash flow, you should take the 1-year zero for the first year's cash flow. What a pain in the neck. I'm not a purist, and I'm pretty lazy. This is not where I want to spend my time. So I'm going to suggest a compromise that I think will work pretty well. It comes from how banks used to be managed in the good old days before they became these complex institutions. They used to do what's called duration matching to manage interest rate risk. What does that mean? If you're a bank, you make a lot of loans, 2-year loans, 5-year loans, 7-year loans, 10-year loans, 20-year loans. And you face interest rate risk on those loans. So what you do is you create an asset portfolio with the duration being the weighted average of roughly equal to the weighted average duration of your loan. So instead of matching each loan up to its own asset, which would be hundreds and hundreds and hundreds of different assets, you duration match. Do you see where I'm going? Let's say you have to do a capital budgeting project. You got cash flows for the next 10 years, every year. Rather than take each cash flow and come up with a risk-free rate for that cash flow, I'm going to look at a weighted average of when you get your cash flows. Right? So basically, year 1, year 2. So let's say the weighted average I come up with is 7.5 years. If I can find a risk-free rate with roughly that duration, I've matched up. It's not perfect, but it's close enough. In fact, I'll make things even simpler. In corporate finance and valuation, you're almost never dealing with 3-month projects. In fact, in valuation, your cash flows go on forever. So rather than try to even finesse this, I would say go with a long-term default-free bond rate as your risk-free rate for every cash flow. It's going to be close enough. Move on. There are other fights to fight. This is not where you want to be spending your time. So for a risk-free rate, I need a long-term default-free
rate. Now that should be straightforward, right? In some currencies, I'm going to argue it's straightforward. In others, but even in those currencies, it's getting less straightforward over time. In other currencies, this can be almost nightmarish. If I ask you, what's the risk-free rate in Zambian kwacha? Or Pakistani rupees? Or Venezuelan bolivar? I won't even ask you what the risk-free rate in Bitcoin is. We're opening up an entire can of worms, right? So I want to start that process, and here's what we're going to try to do. First, remember, risk-free rates not only need to specify the time over which you want the risk-free rate, you need to specify the currency. There's no such thing as a global risk-free rate. Anytime somebody even says that, walk away from that conversation, because that person should not be talking about anything in markets. There is no global risk-free rate. Risk-free rates go with currencies, not even with countries, currencies. You see why I draw the contrast, right? Because especially with the EU covering 14 or 15 countries, you now don't have a risk-free rate for Greece or a risk-free rate for Italy. You have a risk-free rate in euros. So risk-free rate goes with currency. If your currency happens to be a currency where you believe the government has no default risk, I'm going to talk about how you make that judgment, you can just use the 10-year government bond rate as your risk-free rate. So I'll make a confession. November of 2013, when I was doing this, and I wanted a risk-free rate in US dollars, I used the 10-year T-bond rate. But even then, you could see the beginning of queasiness about, is the US Treasury default-free? That's kind of built up over time. If you remember, just a few months ago, middle of last summer, Fitch, which had rated the US at AAA, lowered it to AA plus. Not a bad rating, but it's not AAA rated anymore. AAA in sovereign ratings means there's no default risk. S&P already did that in 2012. So there's actually one big ratings agency, Moody's, that still gives the US a AAA rating. I know this is holding on to a slippery rope, but I'm going to, for the moment, if you ask me what the risk-free rate is in US dollars, go along with the T-bond rate, but leave the door ajar because this could change the next week or the next 6 weeks. So if you have a currency that you believe is default free, and I think the AAA rating might be the simplest way to make that judgment, you can use that rate as, so the Australian dollar, the Singapore dollar, you can go down the countries which have AAA ratings and you can take Swiss franc rate. Right? Probably the most risk-free among in this continuum, the 10-year Swiss franc rate is the risk-free rate in francs. Yes? Doesn't have to be. Just you go with the 10-year. As I said, we've given up on that. We said just long-term enough. We can talk about the 10 versus the 30 for the US, but you want a long-term bond rate in that currency, but the government has. If the government is default-free, therefore, your job becomes fairly straightforward. But let's talk about the euro. The euro, it came into being, 1998, 99, took a painful transition. And you want a risk-free rate in euros. Why? Because you've picked a company in the EU zone. It has all its financials in euros. You want a risk-free rate in euros. You go looking for a government bond rate in euros. And this is the November 2013 graph, but you can see the updated one on my website. Or you can pull it off, in Financial Times. These are all governments that issue 10-year bonds in euros. Let's say you're looking at an Italian company. Which of these rates would you use as your risk-free rate if you're doing your analysis in euros? Somebody said Germany. Why? Don't go economy, because that's going to mean that you have to do research on economies. You want to keep this as, as minimal work as possible. It's the lowest of the numbers. See how simple that is? See why the lowest of the numbers matters? Because the only reason for difference is here. This is in 1997, where the Greek government bond is in drachmas and the German bond is in Deutschmarks. These are all in euros. The only reason for difference is default risk, right? So you want to go with the lowest rate. And the reason I said make it the lowest is Germany is actually teetering on giving up, because since the EU's come into being, the German Eurobond rate has always been the lowest. So we've gotten used to saying, just use the German Eurobond rate. But if you've been watching and following politics in Germany, they're having some issues with their budget that they can't fill in. And the Netherlands 10-year bond rate, the Dutch also operate in euros, is coming awfully close to the German euro bond rate. And during the course of this class, you might see a crossover effect. The Dutch 10-year bond might have the lowest rate. Who knows, the Portuguese 10-year bond might have the lowest rate. Miracles can happen. It's the lowest of the rates because you want something as close to risk-free as you can get. So if you're doing euros, don't take the government bond rate of the country in which you're doing the analysis. Go to the lowest of the 10-year euro bond rates. And the only reason we can compare these government bonds is because they're all in the same currency. But in 2013, these were all of the governments where I was able to find a AAA entity issuing rates. So these are the risk-free rates in different currencies. And you can see Japanese yen, 0.5%. Australian dollar at that time, 4%. So let me state something obvious, but we'll come back and nail down why this matters so much. Risk-free rates will be different in different currencies. And you can see that with the default-free. You think, what if I have to find a risk-free rate in a currency where there is no default-free entity? And 80% of currencies, there is no default-free entity. Brazilian reais, there is no default-free entity issuing a Brazilian real bond. I'll give you the three choices. One is you can start with the local currency, government bond rate. So I can take the Brazilian government's 10-year Brazilian real bond, the Indian government's 10-year Indian rupee bond, start. And then clean up. You're saying clean up for what? The fact that some of that government bond rate is due to default risk. Now, part of you may say, how the hell do I know how much to clean up for? I'll give you three ways in which you can get that cleaning up number, but here's how it would work. In November of 2013, the Indian government rupee bond rate was 8.82%. The default spread based on its sovereign rating, so Baa3 rated country, was 2.25%. Think of this as an algebra problem. The 8.82% is the Indian government bond rate. Some of it is due to default risk. I'm taking out that default risk from the government bond rate to come up with a risk-free rate of 6.57%. Now, I remember the first time I did this in India, I almost had a revolt on my hands. And the response was, why would an Indian government ever default on an Indian rupee denominated bond? There's actually a reason you can give for why government should not default. What should a government be able to do on a local currency bond to always be able to pay it off? You control the printing presses, right? Print more. You're right. In theory, no government needs to default. But in practice, they do. Half of all sovereign defaults in the last 50 years have been local currency defaults. So for whatever reason, governments that can print money choose not to. Why might that be? Why would you not want to print money and pay off your debt? You debase your currency, right? And given a choice between debasing your currency and defaulting, you know what the lesson Latin America taught us? Let's face it, every lesson in sovereign risk you learn from Latin America because pretty much the center of the world in terms of sovereign risk. They've done this dozens and dozens of times, and they've learned. They've discovered it's easier to come back from default than debasement. And I'll use an example to kind of illustrate this. I've been going to Brazil since 1997. I stopped in 2018 finally because I got tired of the long trips. When I went to Brazil in 97, it was 5 years after hyperinflation, 5,500% inflation. There wasn't a single entity in Brazil that could issue long-term securities in reais. Not even the Brazilian government, because nobody would buy it. They did not trust the local currency. It took until 2006 before the Brazilian government could issue real-denominated bonds, 14 years after debasing the currency. In contrast, think of Argentina. In any just world, nobody should lend to Argentina ever again, right? How many times has that country defaulted just in this century? But I'll wager that in the next year or two, you'll know about the next coming of Argentina. I've heard it 5 times in this century. Oh, it's all, Argentina's back, they'll never default again. Right? And we walk into that trap every single time. It's easier to come back from default than debasement. We can talk about why. But it also means that when you have a government bond rate in a local currency, don't assume it's default free just because you have the option of printing money. Because I don't think it is. So subtracting out the default spread will give you a local risk-free rate. In fact, in Chinese renminbi, basically the default spread is smaller, but the process has to be repeated. And already you can see what would happen if 3 months from now, the US were downgraded by Moody's, which is the last thing I'm holding on to as AAA rating, to AA. What would I need to do to get a risk-free rate in US dollars? I need to start with the T-bond rate and subtract out. So don't kind of throw up and say, I can't do anything anymore, the US is no longer AAA rated, right? You're asking for trouble here. The UK used to be AAA rated, it's not anymore. France used to be AAA, it's not anymore. Countries do drop off the AAA scale. Yeah. So this is one option. Stay with the local currency, come up with a risk-free rate in the local currency. This works in India, it'll work in Brazil. It'll probably not work in Russia. There is no 10-year ruble rate. It won't work in, no, Venezuela, definitely. When you get a currency that you basically have no parameters for, either because there's hyperinflation or nothing is traded long-term in that currency, then the second choice is to switch currencies. For the longest time in Latin America, everything was done in US dollars. It's still true in much of Latin America. When projects are analyzed, they're done in US dollars. It's an admission of, I don't trust my own currency. I'm going to, and I'll give you the good news. If you do it right, we'll talk about what you need to do when you switch currencies. You're perfectly okay. So the second choice is to do everything in a different currency. The third is to do everything in real terms. You're saying, what does that even mean? Real terms, you take inflation out of the picture. Currencies have only one reason they affect your analysis. They bring in different expectations of inflation. So if you take inflation out, you remove currency from the discussion, but now you need a real risk-free rate. Any ideas on how I might be able to get a real risk-free rate today? Yes? The TIPS rate, which is a US Treasury inflation-protected bond, right now it's at like 1.6%. You're guaranteed a 1.6% return. Here's how it works. Next year, if inflation is 3%, you'll get 1.6 plus 3. Next year, if inflation is 10%, you'll get 1.6 plus 10. The 1.6 is guaranteed. You have a real risk-free rate. So let me talk a little bit about getting those spreads to clean up your government bond rates. There are 3 ways you can get this spread. If your country has long-term bonds, 10-year bonds issued in a currency like the US dollar or euro, you just got lucky. And here's what. Let's take Brazil. Brazil in November of 2013 had a 10-year US dollar denominated bond. I'm not talking about the real bond, on which the rate was 4.25%. You're saying, how does that help me? Remember, the US dollar at that time, you had a risk-free rate of 2.75% from the US Treasury rate. That difference is a default spread. Much of Latin America, you'll find this choice does give you a default spread because Brazil, Peru, Colombia all have 10-year bonds in dollars. You can't do this. You can't compare a peso bond to a dollar bond, but you can compare a dollar bond to a dollar bond. Eastern Europe, there are countries like, you can get Poland. Poland has 10-year bonds in zlotys, the local currency, but they also have 10-year bonds in euros. You can compare the euro 10-year bond rate to what? To get a risk-free rate. Go to the German euro bond rate for the moment and compare the two. That is your default spread for Poland. So euro, dollars, you just got lucky. Works for about 20 countries in the world which have bonds. India doesn't issue long-term bonds in other currencies. This is not going to work for India. So let's try the second one. It's a market called the sovereign CDS market. Have you heard of it? The sovereign CDS market is a very interesting market. Let's say you buy a Brazilian bond with a 4.25% rate, dollar bond, and you worry about default. And it's giving you ulcers, and you want the ulcers to stop. So what do? You go to the sovereign CDS market, and you buy protection against default. That's what a sovereign CDS is. Well, when you buy insurance, you have to pay for it, right? The way you pay for it in the sovereign CDS market is I'll take away some of your 4.25% every year. Let's say it's going to be 1.6%. So you collect the 4.25%, pay me 1.6%, and you're default free. It's a market-based estimate of the default spread. The reason I emphasize market-based is it's a number that reflects what's going on in the world right now. There are sovereign CDS spreads now for about 80 countries. And I remember the day Russia invaded Ukraine, the sovereign CDS spreads for all of the East European countries, Slovenia, Slovakia, Croatia, all jumped. Why? Because people were scared. That's what market-based measures do, is they reflect things that might make you more afraid of default for whatever reason. So sovereign CDS spreads, so you've gone from 20 countries to 80 countries. But that's still less than half of the countries out there. Right? You say, what do I do with the countries where there is no sovereign CDS spread or no dollar-based bond? Many of these countries have ratings. Moody's and S&P rate about 160 countries. If you can tell me what the rating is for your country, I can tell you what default spread goes with that rating by looking at traded bonds or sovereign CDS spreads. I create a lookup table every year, which I update. So if you tell me your country is, for instance, Baa2 rated, in November of 2013, that default spread would have been 2%. There are some countries like Brazil where you have all three choices. If you have all three choices, pick one and move on. Again, this is not the place we want to be going back and forth on which is the best one. Many countries you have only one choice, in which case your life got easier. If you have a country, if you picked a North Korean company to analyze, I hope you haven't, but if you have, then you're out of luck. There is none of those three choices will matter. But this isn't really your biggest worry if you have a North Korean company. You have other worries you might have to think about. So for the most part, whatever currency you've picked, you should be able to come up with a risk-free rate in that currency. So in November of 2013, I did this for every currency on which I could find a 10-year government bond, a local currency risk-free rate. And you can see it vary across from Taiwanese dollar to Brazilian dollar for emerging market countries. And you can see, again, I'm re-emphasizing what I showed you with the default-free bonds. Risk-free rates vary across currencies, just across emerging markets as they do developed markets. So I'm going to update this graph. This is a graph, as I said, I update every year. Start of 2024. This is what risk-free rates look like in different currencies. At the start of 2024, the currency with the highest risk-free rate is the Turkish lira. And what I've done here is taken the government bond rate, that's the height of the entire column. The red part is the default spread I'm subtracting out. So the blue part of this graph is your risk-free rate. The risk-free rate in Turkish lira is about 17%. Think about that. If you're estimating a hurdle rate in Turkish lira, you're starting with 17% and you're building up. So don't be surprised to see 25, 26, 27% cost of capital. Next highest is the Zambian kwacha, and you can go down. You've got the middle of the graph, and then you get to the low risk-free rate currencies. Japanese yen has been at that low end of the spectrum forever, 40 years. And it's actually negative. Which you say, what the heck does that even mean? It's kind of mind-boggling to think about it, because it doesn't make intuitive sense. Because when you have negative interest rates and you borrow money, what do? The bank pays you. Sounds like a great deal, right? That's what negative interest rates do. So we'll talk about what it is that causes the rates, but maybe you can give me an opening. So here's my question, and this question, if you can answer it, you've cracked the currency code. Why do risk-free rates vary across currency? I didn't ask you why government bond rates vary, because then you could do a risky government, safe government. Let's have cleaned up for default risk. And that blue portion of the graph is the risk-free rate. Why do risk-free rates vary across currencies? Yeah. Different, let's forget about the economies. There are different inflation rates in different currencies. And if there are different inflation rates, you're going to have different. So high inflation currencies will have high risk-free rates. Why is the Turkish lira risk-free rate so high? If you've been to Istanbul recently, or you've talked to somebody who has come from there, they'll tell you how inflation has ravaged. I mean, this is not recent. This has been quite a few years. So high inflation currencies have high risk-free rates, low inflation currencies have low risk-free rates, and deflationary currencies could have what? Negative risk-free rates. So if somebody asks you, how can risk-free rates turn positive? It's uncommon, but it's not unnatural. It can happen. There's one, so Japanese government bond rate being the risk-free rate being negative, I get, because I've seen it at the Vietnamese dong threw me off for a loop because I wouldn't expect the Vietnamese dong to have a negative risk-free rate. And I am skeptical, and here's why I'm skeptical. What do I start with to get my risk-free rate? The government bond rate, right? And the US, you can debate the T-bond rate and whether you like it or not, but it's set by demand and supply. This is the deepest and biggest government bond market in the world, traded constantly. It's set by demand and supply. I'm not sure I can say the same about many of these government bond rates. So I did a little research on the Vietnamese 10-year government bond. I couldn't find a single place where I could trade it. That's actually revealing when you can't find a tradable. So I said, who's holding these bonds? It turns out the Vietnamese government bond issues 10-year bonds. And much of it, they require Vietnamese banks to hold. There's no, do you want to? You have to. At whatever rate the government sets. So I'm not sure that that government bond rate is a good starting point. So if you're working with a Vietnamese company, you're saying, what do I do? I'll give you a way out of this box, but I'm saying if you start with the government bond rate, remember that government bond rate is more believable, more trustable when it comes from a market where there's trading in the market. So risk-free rates vary because of differences in expected inflation. We'll come back to that when we talk about, hey, should it then matter whether I value a company in dollars or in Turkish lira? What's your first response going to be intuitively? It should, right? Because the discount rate should be much higher in Turkish lira. It turns out that it doesn't. And I want you to start thinking about why changing risk-free currencies will not affect your value. Yes, go ahead.
You mentioned that you can estimate the default spread based on the rating. When does default spread start occurring? Like what ratings?
Well, technically, no, AAA bonds, basically the way we define default spreads, we compare it. So AAA bonds, we assume those are risk-free. So there's no default spread at AAA. You drop even to AA2, which is the next level, you're already going to see a tiny amount of default spread. That's why I said, if the US Treasury is lowered by Moody's from AAA to AA2, we'll have to adjust the default spread. But it'll be tiny. It's 0.2%, 0.3%, something to reduce that default risk that's now going to get embedded in there. Yeah.
Didn't Fitch lower them to definitely?
Yeah, and I think that's why I said at this point the door is ajar now, right? Because there's one ratings agency left, Moody's, that has a AAA rating. When that goes, that crutch is now gone, right? I can't say, well, there's one ratings agency that gets still good. Then I have no choice but to adjust for it. For me, it's a little bit of a nightmare because so many of my risk premiums start with the US equity risk premium. But it's actually a mechanical adjustment where you have to adjust for the fact that you now have default spread in what you used to call your mature market base. No, but it's doable. It's exactly the same process. Now, before I finish risk-free rates, and you think about it, I'll give you at least a start to why currency should matter. If you pick Turkish lira to do your analysis, you'll have a higher risk-free rate and a higher discount rate. True. That's bad, right? But when you discount your cash flows in Turkish lira, your cash flows have to be estimated in Turkish lira as well. And how do you estimate cash flows? You look at the real growth you're going to have as a company, and then you bring in the inflation effect into those cash flows. If you live in a high inflation economy, growing at 17% in Turkey is almost effortless. Basically, mature companies, all you need to do is sell this exact same output next year, raise prices by the inflation rate and pass it through. You see where I'm going? If you're going to do your analysis in a high inflation currency, your discount rates will be higher, but so will your cash flows. And for the moment, you just have to trust me that the value you get will be the same, because later when we do investment analysis, I'm going to take a project, do it in dollars, then I'm going to redo it in Brazilian reais, and you're going to get the same net present value for the project either way. But it's only because I'm staying consistent. So that's the risk-free rate. Let's talk a little bit about the equity risk premium.
The equity risk premium is the premium you demand over and above the risk-free rate for investing in equities as a class. So there's no company-specific thing. So I'm not saying there's no equity risk premium for Disney and an equity risk premium for some other company. It's just a price of risk in the market. So think about what goes into this. Do you think fear plays a factor here? Yeah, when you get afraid, you're going to push up the risk premium. Do you think greed plays a factor? Absolutely. Do you think what's happening in the world, everything affects that premium? And by definition, if everything affects the premium, that premium is going to be a shifting number, going up and down. So keep that in the background. But here's why it's so difficult to estimate it, because it depends on how risk averse you are as a person. As risk aversion goes up, the risk premium goes up. And it'll also depend on what you perceive as the riskiness of the equity market. Remember, that's a shifting number as well, right? Today you might say equities look safe, and tomorrow you might say equities look incredibly risky. So the question is, how do we estimate that risk premium? Because it's going to change as the market changes and investor composition changes. So I'm going to run a little experiment. Let's assume that you're an investor and you're very risk averse. You've invested all your money in something risk-free, and you're earning 3%. I've quit my job and I've become a salesperson for the Vanguard 500 index fund. So I call you while you're having dinner, right? Because that's what cold callers do. And I try to convince you to move your money from where it is today, 3% guaranteed, into the S&P 500. So I'm being very clear about what the switch is. So here's my question for you. You're making 3% guaranteed. I'm trying to get you to move your money into the S&P 500. How much of an expected return would you need to make? Remember, there's no guarantee now. You're entering equities. It could be, there's risk here. How much of an expected return would you need to make the switch? There's no right answer. Don't look at your neighbor. Says, I go through the choices. If this is where you'd fall, put up your hand. How many would accept an expected return between 3 and 5%? Okay, 5 and 7. Okay, let me pause right there. Are these the least risk-averse people in the room or the most risk-averse people in the room? Try again. Least. Because the less risk-averse you are, the quicker you're going to jump into risky investments. So you're saying, I'm okay. So if you pick 5 to 7, what did you say your risk premium was? Between 2 and 4%, right? So hold on to that. There are about 5 people who've said the equity risk premium between 2 and 4%, they're okay with it. How about 7 to 9? Yeah, it looks like we're moving to the middle of the distribution. So your risk premium is between 4 and 6%. 9 to 11? 11, more than 11%? Most risk-averse people in the room? I mean, say, why? And this is actually, if you think about it, a fairly homogeneous group, right? In terms of age, in terms of where you are. Look at how much difference there is in risk aversion in this room. And then think about how this is going to play out in the entire market. We do know things about risk aversion that we've learned by looking at people over time. We know that risk aversion tends to, in terms of age, are older people more risk averse or less risk averse than younger people? I'm not putting rollerblades on and going on the Venice beachfront. I know exactly what can happen to me. My grandson, who's 5, does all kinds of things. He doesn't seem to know any better. Let's face it, as you age, you get more risk averse. And there's an economic story here, right? Remember I said Japan has really low risk-free rates? You think that's a good thing. It comes from deflation. It also comes from an expectation that real growth is low in Japan. Low risk-free rates are not good news. They reflect expectations that are pretty downbeat. So what is it about Japan that has kept them at this low end of the risk-free spectrum for 40 years? Why is there deflation? Why is real? I'm looking for what's the driver of these? It's the demographic. They have a demographic problem, which is the country is aging incredibly. I mean, take a look at the median age of somebody in Japan. I think more than half the population is heading towards above the age of 65. You're saying, so what?
Well, as the population ages, economic growth will drop off because older people consume less than younger people. So in a sense, that's the economic growth component. But there's a risk premium story as well, right? Is Japan's population is aging, what should happen to equity risk premiums? They'll rise, which will do what to stock prices? Go down. That could be part of the reason Japanese equities have been stuck in the doldrums now for 30 years. Which raises an interesting question about where the world will go over the next 10 years, because what's the second largest economy in the world? China. And if you think the demographic time bomb was a problem in Japan, think about what that'll mean for the global economy. And don't think it's going to be isolated just to China. If what people are forecasting for China over the next 10 years comes into play, it's actually mind-boggling in terms of how much the population is expected to drop and how much it'll age. So when you think about risk premiums, the risk premium is going to vary across age. Would you think it varies across sex? Men more risk averse than women, or vice versa? What do you think? It's a kind of touchy area. But here's what the research shows. This way I'm fully protected. You can't accuse me of making up stuff. Young men are much less risk averse than young women. It's been well established. But as you age, risk aversion evens out. Though men remain less risk averse still, or let me put it differently, women remain more risk averse on small bets. You probably noticed it around the Super Bowl. Men bet like it's going out of style, $100 if he scores a touchdown. Women, $5, let me think about the probabilities. By the time they get back, there is no bet, right? Because they worked out that this is a bad bet. So risk aversion varies across age, it varies across men and women. And it varies across people because we're all born with this risk aversion component in our stomachs. I can tell you, I have 4 kids, I can tell you which ones are going to be invested in bonds for the rest of their lives and which one's going to be the option trader. My oldest son, who's now 34, still walks down the stairs holding on to the banister. A fixed income guy, if you ever saw one. I might fall now, how about right now? My youngest, when he was 3, took off from the top step, expecting to be caught before he hit the bottom. This is an option trader right there, right? Something good will happen. Let me just take the risk and jump in. You can't change that. No, we're born with risk aversion coefficients already inside. As we age, that might change. But the bottom line is risk aversion varies across people, and it varies across time. And here's why. I mean, you gave me your estimates of the risk premium right now, right? Do you think that might change next week? February 2020, I asked this question in my corporate finance class. We were talking, and I think people came up with like this 4.5%, 4%. And then, of course, 2 weeks later, COVID hit, and 2 weeks into COVID, I asked people the same question. The premium jumped 2% across the class. Because that's what fear does, is when you're worried the global economy is shut down, what's going to happen, you're going to see risk premiums change. So not only is risk premium different across investors, it's going to vary across time. Which basically also means that when you look at risk premiums, having one number that stays fixed over time is kind of being in denial. The real premium is changing, and you want to try to estimate it. So when you think about a crisis, say while we're sitting here, nothing's happened, don't freak out. During the course of the class, let's say the market dropped 25%. It can happen, right? Think about coming out of the class, looking at that news story, and asking, what will that do to the risk premium I came up with in class? How many of you now demand a larger premium? I think that we might be underestimating how much it'll impact because it's in the abstract. If it really happened, I'll wager a lot of people say, this is what I'm out of equities. Is it possible that some of you might demand a smaller premium? And what would be the rationale for it? Yeah, if I could buy the index, the S&P 500 at 5,000, it's even cheaper at 3,750. This is the classic contrarian value investing position. It's a little harder to put into practice than it is in the abstract, but risk premiums can change as the market shifts.
So we've struggled with how to estimate risk premiums, and I'll give you the 3 ways we've come up with estimating the equity risk premium. The first is to ask people what their equity risk premium, just like I did you. It's a survey premium. What do you think stocks will do? And look at the difference. I'll talk about why almost no one uses survey premiums. But I see it done all the time. People will estimate. Second is to look backwards. Look at what's called historical premiums. What does it tell you? What you'd have earned on stocks relative to something risk-free, treasuries, over the last 10 years, the last 50 years, the last 100 years. And there's an intuition here, right? Which is, if that's what I've earned in the past, that's what I should expect to earn in the future. We'll talk about what might cause that linkage to break down. The third approach is to estimate a risk premium that reflects where the market is today, a forward-looking premium. When I started, I was told there was no third approach, and I'll talk about what I've tried to do to come up with that third approach and why I hang on to it, especially in the market we're in right now. So let's start with the first approach. First approach, you ask investors what they would demand as a return. And the way this takes the form is, what do you think stocks will do this year? Give me a percentage return. The problem is you can't ask all investors. There are too many of them, so you got to pick a subset. So the surveys vary depending on which subset is focused on. And I've looked at a few subsets. One is the Securities Industries Association, which is this trade group, used to survey individual investors that they picked at random. 5,000 people, they would tell me what your expected return is. They did it until 2004, and finally they gave up because what they discovered is they weren't getting expectations, they were getting hopes. You know what I mean by that? You ask investors, what do you think the stocks will do? I hope it'll go up 18% because I need that money. And they'd say 18%. So they gave up on that. Merrill Lynch has been serving institutional investors. I think they might still be doing it. It's really opaque, difficult to get to the number, but they asked big institutional investors, what do you think stocks will do over the next year? So let's say they say stocks will be up 11%. You take the 11% and subtract out the 4% equity risk premium. The third is Campbell Harvey and John Graham, 2 professors at Duke, do a survey of CFOs. You're saying, why would CFOs think about the risk premium? Because it becomes a number. They used to get hurdle rates. And those risk premiums reflect what CFO. The fourth grouping is equity research analysts who tend to use risk premiums in intrinsic valuation. Pablo Fernandez does that update every year. I think he's been doing it for 20 years. So you can get a lot of these survey numbers. And then finally, the most useless of all the surveys is of academics. And here's why. Remember I asked you what your equity risk premium was for each of you? If this were the market, you know what the equity risk premium for the market should be? A weighted average of all of the numbers you came up with. You're saying weighted by what? Not how much enthusiasm you showed when you put up your hand, but how much money you have. Let me be brutally honest with you. If you have no money, I don't care what your risk premium is. You can shout it, you can yell it. It doesn't matter. If you have 10 billion, I'm really interested. That's the reason what Warren Buffett thinks about stocks matters more than what everybody in this building and the neighborhood probably think about stocks right now, because that's what $40 billion brings to the table. Now do you see why the academic survey is so useless? There's no money behind it, right? But we teach all these classes, we throw equity risk premium, so I guess these surveys tell you, what are you teaching in your class? So maybe you have an outsized impact because of that. But the problem with all of these surveys is they all tend to be short-term, 1 year estimates, not 5-year, 10-year. Second is, they tend to be more reflective of the past. What does that mean? You come off a good year for stocks, the survey premiums go up. If you come off a bad year for stocks, the survey premiums go down. They're reacting to what they saw in the last year. And finally, you can get some absurd-looking numbers in these premiums because there's no money behind it. You ask me what the stocks will do next year, I can say 85%. Nobody that I know of uses survey premiums in equities or in corporate finance. The one area where I've seen survey premiums used, and even there it's dropping off, used to be real estate. There's this outfit called Cushman and Wakefield. I think they're New York based. And what they do is they survey real estate developers around the country. And what they ask them is, what are you expecting as a rate? Now, they use the term cap rate, but basically as an expected return. And then they publish it. They used to publish it every quarter. You can see if they still do it. what the cap rates are by region and by type of property. So let's say you're looking at a commercial property in Florida. You can go to the table, commercial property in Florida, 8.3%, premium of 5.3%. That's the only place I've seen surveys used, and it used to work in real estate because it used to be a nice, small, closed market, real estate developers. What's breaking it down is who's the largest investor in real estate in the US right now. Whenever you don't know the answer to a question like that, just say BlackRock. It tends to work pretty well. Right? It's private equity investors, BlackRock, and what that has done, it's broken the stranglehold of developers, because what BlackRock demands as an expected return is very different than what these other investors might be. So surveys, you can see them all the time, you'll see them reported. Don't attach too much weight to them. The second approach is to look backwards, a historical premium. And it's mechanically not that complicated. First, you define what period, right? 10 years, 50 years. In the US, you have historical data that is reliable, that goes back to the mid-20s. 1926 was the crisp database of that. But if you want to go back even further, Bob Schiller has data going back to 1871. So the US, you have history going back to 1871. You have to decide what portion of that history to use. Second, you compute the average returns on an equity index over that period. Third, you compute an average return on something you call risk-free, treasury bills, T-bonds over the period, and then you take the difference. This isn't rocket science. That's all a historical risk premium is. But it is built on two assumptions. The first is what's called mean reversion, that things revert back to the way they used to be. Is that a safe assumption? As long as there is no structural change. I remember last year, when the Mets signed Jason Verlander. With great pitchers. They did it. If you look at his history, amazing pitcher, right? He's won World Series, ERA, 3 Cy Youngs. But there was no mean reversion for a simple reason, which is he was 39 years old. You're not going to revert back to the way they used to be because structurally you've changed. You see where this is going, right? If you assume mean reversion in markets, you're assuming there's been no structural change in markets. And if that breaks down, the assumption breaks down as well. So let me show you what the historical risk premiums look like for US equities. And I'll tell you up front, I don't use these historical risk premiums ever, but other people do. 95% of people, when they talk about equity risk premiums, are talking about historical risk premiums and why I don't trust them. So if you ask me what the historical risk premium for the US is, I'm going to give you an answer that's not going to satisfy you. Some number between 4 and 11%. And technically, I'm right. And here's why. It depends on the slice of history you look at, right? Go back all the way to 1928, which is the starting point for my data. You can go back 50 years, 10 years, or any intermediate period in between. So your risk premium varies depending on how far back you go. It varies based on what you use as risk-free. T-bills are short-term. T-bonds are long-term. What you define as risk-free is going to define what your premium is. It even depends on how you compute your average. See, what does that mean? The simplest way, the way you compute averages is you compute a simple average. Take 85 years, take returns every year, add them all up, divide by 85, arithmetic average. But there's another way to think about money. Money earns money. So I know that sounds weird. But if you invest $100 in 1928 and you look at what it's worth today, and you look at the average that you earned, a compounded average, it's going to be very different than your arithmetic average. How far back you go, what your risk-free rate is, and how you compute average can give you very different numbers. And all of these numbers are crappy. Why are they crappy? Because remember statistics, when I take 85 years or 85 observations, compute the average, in statistics, what are we trained to put in brackets below the average to tell the world how uncertain you are about the average? A standard error, right? The standard error, if I go back all the way to 1928, is 2.14%. And to see why that's significant, remember I use the T-bond rate as my risk-free rate, and I believe the compounded average makes more sense because this is going to get compounded over time in a discount rate. My equity risk premium is 5.23%. That sounds incredibly precise. Second decimal point. until I tell you the standard error in that number is 2.14%. If you remember your statistics, that basically means the range on my equity risk premium is anywhere from 1 to 9%. And that is with, if I go back all the way to 1928. If I go back only 50 years, the standard error gets larger. 10 years, it becomes almost all noise. Historical risk premiums are incredibly noisy, but if you have to pick one, go back as far as you can, even though that puts you back in 1928, 2 years before the Great Depression. Very different market, but you almost have no choice. So if you have to pick a historical premium, go with the 5.23%, then cross your fingers and hope that it's somewhere close to the right number, because there's a huge amount of noise in your estimate. Which at least sets me up to why I decided. So until 1993, when I taught this class, I would teach with the historical, because that's what everybody used. And I started to get more and more uncomfortable with it. And I'll tell you, my complete breaking point with historical premiums happened in 2008. If you ask me what happened in 2008, no, then clearly you're really young and you don't know what happened. It was a painful year. It was a painful year in terms of adjustments. But the lesson I got from 2008 is, guess what? You're in the 21st century. It took me 8 years into the new century to get that. And the world is no longer a world where the US economy is the global economy, that this is a world where you can have lots of things happening. Even if it was a reminder that structurally the world had shifted. I wanted a forward-looking dynamic premium. And to understand what I'm going to do, here's what I want you to think about. You know how you compute the yield to maturity on a bond? Nod your head even if you don't, because otherwise your foundation's in sick. Somebody want to help me? Guillermo? You take the price, you take the coupons and the face value, and the yield to maturity is that discount rate that makes the present value of your cash flows equal to it's an IRR for a bond. I looked at that in the early 90s and said, why can't I do that for stocks? So the price of the bond, I'll take the price of the index. Instead of coupons, what do I get as cash flows? Dividends, and in the US increasingly buybacks. It's true, stocks go on forever, so I need some way of putting closure. If I can compute an internal rate of return for stocks, I've essentially got an equity risk premium that's forward-looking and dynamic. So I'll leave you with this page, because we'll come back and fill in the details and talk more about this. I call this an implied equity risk premium. I started computing it for the first time in 1993, and I compute it monthly now. So it's on my webpage and my front page. It's what I use as my equity risk premium for mature markets, for the month of February. So March, I'll have to update. So here's what I do. There's the level of the index on November 1st of 2013, 1,756.54. So buying a bond, you bought those stocks. The 12 months leading into November of 2013, remember, unlike a bond where I know what the coupons are going to be, with stocks, I know what the dividends were last year, but I have to forecast them for the future. So I started with what they had as cash flows in the most recent year. And notice that in 2013, 60% of the cash flows you got as equity invested in the US came from buybacks. We'll talk about the shift that has happened in US equities. And then as a final piece, I looked up what analysts were projecting as a growth rate in those earnings. I've got my pieces in place. I take the cash flows, grow them at 5.59% for 5 years. At the end of 5 years, what happens? I can't keep assuming this growth rate in perpetuity, because these are the 500 largest market cap stocks in the US. I assume the growth rate would converge on the growth rate of the economy. And rather than ask economists what that number is, I'm going to use the risk-free rate as my proxy for it. So there's my equation. What you paid for stocks, expected cash flows beyond year 5. I solve for the discount rate. Little messier than a yield to maturity in a bond. I used to solve a function in Excel. I came up with 8.04%. You say, what does that tell me? At the start, November of 2013, if you bought US stocks, given what you paid for those stocks, that's what you can expect to make as a return. This is not a survey number. This is based on what you paid. You subtract out the T-bond rate, that at 2.55%. My implied equity risk premium is 5.49% on November 1st of 2013. Will it change over the next 30 days?